what is a candlestick, combining candles, how to trade candlestick patterns, and top candlesticks for potential reversal. A candlestick tells a story. It tells a story between buyers and sellers. You will have green candles that are buyers pushing the price up, and you will have red candles that are sellers pushing the price down. Let's first talk about a green candlestick. A green candlestick opens at the low here. Buyers in this particular candlestick push the price up all the way to the top, and then sellers push the price back down, and the candle closed here. These lines are called wicks. You will see a wick at the top and the bottom. The low of the day or the hour is at the bottom of the wick. The high is at the top of the wick, and the close is at the top of what we call the body. So the body is the part that's colored in. The wicks are the sticks that you see at the bottom and top. The high is at the top of the wick, the low is at the bottom of the wick, and the difference between a green candle and a red candle is that it's opposite for the open and close. On a red candle, it opened at the top. Sellers pushed it all the way to the low, and then buyers pushed it back up, and it closed at the bottom here. We have monthly candles, weekly candles, daily candles. We have 12-hour candles, 9-hour candles, and so on and so on. We even have candles that go all the way down to 30 seconds. When you see a candle with a small wick at the top and a big body, it means that buyers pushed this candle all the way up to the high, and sellers were only able to push it down just a little bit, and it closed here. That's why we call it a weak price rejection, because the sellers were only able to push it down just a little bit, and we have a big body of a candle. Over here, as you can see, we have a very long wick and a very small body. This indicates that buyers are weak and the sellers are strong. So what happened here is the buyers pushed this candle all the way to the top. Then the sellers came in and were able to push it all the way back to the bottom, and it closed here, leaving a very small body. So in this candle, sellers were in control. Candlestick shows you who is in control, the bulls or the bears. Pay attention to the body relative to the wicks. So as you see here in this candle, we have a very big body, which means the buyers were in control. If this was a red candle, it would mean the sellers were in control. But for the sake of this slide, it is a green candle, so the buyers were in control here. We have a very long body compared to the very small wicks. This candle, we have a wick with a very small body and a wick on the other side. The wicks are of even length. This is called a neutral candle. A candle with a very long wick and a small body at the top is a very bullish candle, because what happened here is the sellers tried to push this candle down, and the buyers took over and were able to push it all the way back up to the top and was able to close this candle up here. This is a very bullish candle. In the prior slides, I told you that we have weekly candles, monthly candles, and so on. Here is where you combined the candles. So we have a 4-hour candle and we have a 4-hour candle. And when you combine these two together, it gives you this 8-hour candle. So let's talk about what happened here. So we started out with this 4-hour candle. So the buyers were able to push this candle up to the top. The next 4-hour candle opened at exactly the price that this one closed at. The sellers were able to push the price all the way down to this low of this wick. Then the buyers came back in and were able to push it back up to here, and it closed, creating this 8-hour candle. So these two combined create this candle with a long wick and a short body. So even if this said 1 hour and 1 hour, it would equal a 2-hour candle. Let's show some examples here. These two 2-hour candles and these two 2-hour candles create this one 4-hour candle and this one 4-hour candle. So every one of these candles that you see in here is a 4-hour candle. So it took 4 hours to create one of these candles. You don't trade a candle in isolation. Just because it's green, you don't go long. And just because it's red, you don't go short. Here in this chart, this was a red candle. You had 3 in a row here. You would naturally see this and think it's going to continue to go to the downside. But then all of a sudden you get this big green candle and you get totally wrecked. Over here, you see 3 green candles in a row and you think, oh, it's reversing. Well, look what happened. If you would have went long here, these red candles would have came and took you out. There are 3 basic things that you need that I have put together and called it TAE. T-A-E. The number one thing that we start out with is trend. What trend are you in? Are you creating higher highs and higher lows? So that means the trend would be up. If you're creating lower highs and lower lows, the trend is down. Another thing you can use is, are you above or below the 200 MA? On this chart is the 200 MA. When we broke above it, the trend was up. And over here, when we broke below it, the trend was down. That is another concept that you can use. Also, is RSI over 70 or below 30? When RSI was at over 70, we were in overbought territory, which most of the time will cause a downtrend or a correction. RSI was below 30 in the oversold territory. Most of the time, you're due for an uptrend. T is identifying the trend. These are not the only things you can use, but these are some examples. A is area of value. Are you at a major support or resistance area? Are you coming up to a trend line? Do you have a channel break, or are you coming up to a certain Fibonacci level? That here you have hit the 618, and most of the time on a rebound, when we've hit the 618 and we're going to downtrend again, that is where we'll downtrend. A channel break, that we're breaking this channel to the upside. A trend line break would be the same thing as if you drew a trend line across the top here and we're breaking it to the upside. And the last thing is an entry trigger. Do you have a reversal candle pattern? The first one is called an engulfing pattern. We have this red bearish candle, and regardless of the time frame, which the higher the time frame, the better. If it's on the 4-hour, the 8-hour, the daily, the weekly, the stronger the signal. So we had this bearish candle, and then we had this green one come in and completely engulf it. On the opposite side, we have what's called a bearish engulfing. So the buyers took this candle up. When this candle closed and this one opened, the sellers took it all the way back down and completely engulfed this whole candle. This is what we call a bearish engulfing. The next pattern is called the hammer and shooting star. The hammer usually will have a candle, and you will see this at the bottom. And what will precede it is a candle and a candle to the upside. That is very strong buying pressure. And usually you will get a reversal. So let's talk about a shooting star. You can see this candle at a top of a trend, and then this candle, the buyers take it all the way to the top, and then the sellers come in and bring it all the way back down. This is a major rejection. And most of the time is what you'll get is a push to the downside afterwards. This is what's called a shooting star, Dragonfly, and a Gravestone Doji. It is almost exactly the same thing as the hammer and the shooting star. It just has no body. It's just the buyers and the sellers have pushed it so far that there's barely any body there at all. A morning and evening star, the price is coming down, and then you get this little tiny candle with pretty much equal wicks on both sides and a small body. This means that the buying and the selling pressure are equal. Some say that it's market makers injecting large funds into the market. Whether that is true or not, I'm not exactly sure. But when you see this, along with your other area of value and trend, it can be a potential reversal. When you see two candles with the wicks of equal size and they both have rejected at the same spot on the bottom, that is a very strong bullish sign. On the opposite end, the opposite happened here. We were rejected from higher prices twice. Very strong reversal signal to the downside. You have resistance here. So your area of value is this resistance. We came up and we were rejected from this area. We came up again and we were rejected again. As we came back up for the third time, we created a shooting star. The two rejections at resistance combined with the shooting star gives you a signal that we will be rejected again and move to the downside. Have a resistance of a moving average that we have been underneath. We come up to the moving average and we are rejected. Right after that, we create a bearish engulfing candle. It completely overtakes the green candle before it. The rejection combined with the bearish engulfing candle gives you the potential to continue this downward trend. Here we have a moving average and we're above it. Right here, we came to the moving average and bounced off of it. We came back to it and we created a bullish engulfing candle. This was a signal, along with the rejection, that we would continue the trend. The two prior bounces off of it and then another bounce gives you the signal, along with the bullish engulfing candle, that the trend will continue. Not just the candlesticks by themselves. We have a trend line support. We come down to the trend line, we bounce off of it once, twice. We come back to it again, and now we have a bullish engulfing candle off of trend line support. Along with the trend line support for the third time with the bullish engulfing candle gives you the signal that this is a potential bounce again to the upside. We have resistance above us. We break through it. We come back up to it. Strong rejection with this bearish engulfing candle. Then we come back to it again and we create the tweezer tops. Gives you the potential that we are going to continue in the downward motion. Moving average resistance. We have stayed under the moving average. We come up to it. We create an evening star along with a bullish engulfing. Gives you the signal that this trend will potentially continue to the downside. Now there is many more out there. There's a PDF sheet that's attached to this of candlestick patterns. So I hope this course was easy to understand, and I thank you for watching.